Hi, welcome back to Tea Talks with OnLadder. My name is Cameron Orcutt, CEO and co-founder of OnLadder. As part of our ongoing interview series, we talk to industry leaders within the property and mortgage industry in order to talk about the big topics of the day. Over the past year, we've seen a confluence of factors contribute to a grimmer economic outlook, whether it's higher interest rates, higher inflation, the energy crisis. There's been a lot to digest. And what this has called for is a bit more flexibility for mortgage lenders. One of the parts of the sector that can really help with that is the specialist lender. So for us, we wanted to bring in someone who could very much speak to that and how the specialist lending sector in the mortgage space could bring about better outcomes for first-time buyers and for mortgagors. And with that, good to see you, Richard.
Good to see you too, Ken.
Yeah. So, Richard, I mean, you've been around the block. Like, you've been at multiple different, specialist mortgage lenders, and more recently, I mean, you've come on as an advisor for a particular startup, namely OnLadder. Can you tell us a bit about yourself, your background, and what are you up to now?
Indeed, it's hard to believe, I know, but I've been 40 years in the industry now. The majority of those years were on the high street. Spent 30 years with high street lenders. But for the last 7 or 8 years, I've been with specialist lenders, firstly with CHL and then with Together, and lastly with Vida Home Loans. And it's very interesting, really, because I think the two worlds are overlapping but different. And it showed me a few areas where perhaps the industry needs to get together and do different things. And OnLadder came along at an interesting time, really, as a potential solution for some of those things.
But I guess, like, getting into the meat of it, like, there's been a lot that's happened over the past 6 to 12 months. There's, I kind of alluded to it earlier, but there's been the mini budget, which caused a premium on interest rates. There's been the energy crisis. There's been, just a general, risk of inflation that's been going on. And really, this is where maybe mainstream lenders can't provide as much flexibility, but the specialist lender can. I guess, can you speak to that and how it could potentially help people that are trying to remortgage or people that are trying to get on the property ladder for the first time?
Yeah, definitely. I think what you've seen, probably longer than the last 12 months, but the last 12 months, for the reasons you've said there, have brought it to the fore, really. People have struggled in a number of different ways to get their mortgages from the high street. And that's why specialist lenders have started to provide solutions. Mortgage brokers predominantly have started to become aware of those solutions and therefore advise on them to their clients. And there's a number of different reasons why that's happened. The income and employment situation has been happening for a few years. The high street tends to like people that are either long-term employed or long-term self-employed, so they can see a track record and they can see income track record.
A bit more vanilla.
Yeah, exactly. I mean, the high street are not completely vanilla. There are elements of the high street proposition that will look at some of those clients. What they don't tend to be very good at is layered risk, as they would call it. So if someone's self-employed, they understand what that is. But if someone's self-employed and they've got some type of credit issue, or they're buying a property that's unusual, or they've got issues in their past somewhere, then they aren't necessarily very good at layering that risk. They'll do one thing but not 2 or 3. And that's where the specialist lenders can come really to the fore, because they are able to underwrite and to look at that individual as a person rather than as a proposition.
Yeah. So this is something where, when we talk to first-time home buyers, when we've done our customer interviews as part of our customer discovery process, this is one of the things that comes up every now and then. Like, they may have something that they didn't, a CCJ or some sort of adverse credit that's come across, but that was years ago. But they're nervous that that's going to affect their ability to get a mortgage now. So what you're saying is that specialist lenders could really help with that and provide a bit more flexibility for those types of customers.
Well, they look at the type of risk that the customer is. So they look beyond that maybe credit blip, or it's not just a credit blip. Sometimes it's that people haven't got enough credit. So they can't prove any track record of paying back credit, and that can be an issue too. It could be that they're self-employed and maybe they've had fluctuating profits, or maybe they haven't been self-employed long enough to show a real track record, or they could be employed with non-standard income. So they could be finding that they've got income from various sources, or they take dividends as a director, or they have fluctuating income because they're taking bonus or commission in, or they're in the gig economy, as they would call it, where their income's not necessarily standard. So it may not necessarily be an issue with credit. It may be that they haven't got enough credit to be able to prove a track record there. And on the income side, it could be that they're self-employed but haven't been self-employed long enough to show a track record, or their profits have fluctuated, particularly during the COVID years. If they were in an industry that was affected by COVID, they may have a great business but have seen it dip and pick up again. And I think the crux of the high street versus specialist conundrum comes in underwriting, because it's down to whether the high street have got the time or the inclination to want to underwrite personally a loan, or whether they want to do it on a conveyor belt type process, whereas the specialist lender is more likely to underwrite the individual despite or even because of some of the issues they've got.
So yeah, actually going back to a point that you just mentioned with regards to, say, mainstream lenders being more of a conveyor belt. So I guess it's more of with their processes, it's highly automated. And for them, they don't really want to change that. If they change that, then that causes all sorts of problems on their tech stack. But for a specialist lender, they can be more manual, and it doesn't necessarily affect their processes as much.
Well, they almost have to be. So if you look at high street, it tends to be an underwriting department. It is a conveyor belt process. It tends to be loans that are coming in that fit their criteria. They may be able to massage slightly around the edge, but generally the criteria is known by brokers, it's known by direct customers. They either fit or they don't, they're either in or they're out. With a specialist lender, there's a story to be told, and specialist lenders tend to have underwriters rather than underwriting departments. Many specialist lenders will send underwriters out on a roving basis, certainly to packages, but probably to bigger brokers as well, so that the broker can say, look, I've got a case here, but it's got this, and this issue with it, but overall it's a good case because of this. So it's always what's right for the customer. It's always making sure it's affordable and it's right for the lender and for the customer, but it needs someone to look laterally at the proposition rather than just fit it to criteria.
Yeah. So with more of a mainstream lender, it's more of a, this is what we're doing. But with, say, a specialist lender, it's more of a conversation between them, the borrower, and also the broker.
Yes.
Okay. That's great. Actually, going back to something that you mentioned even before this, with regards to specialist lenders, they're more flexibility in the underwriting process and recognizing an income that, say, a potential borrower is bringing to the table. In this current climate, with interest rates going up and the amount you can borrow going down, it's even more important that they have as high of an income, as much of their income to be recognized as possible. So I guess could you speak to how specialist lenders can, say, help with that in order to help, say, first-time buyers or even people that are already on the ladder trying to remortgage?
Yeah, and affordability is still absolutely key. Of course, it should be. The regulator makes sure it is, and it's the right thing to do. But how you assess affordability, how you take in income from the individual, how you look at the individual's ability to pay a loan, who may have been paying a very high rent for quite some time as well, and perfectly able to afford and show that they can afford that. But possibly they're in a business where it had a high profit 2 years ago. During COVID, the profit dropped, and now it's picking up again. The high street don't like that because it's fluctuating profit. They've got to almost prove why it dropped, even though everyone would know why it dropped.
Right.
If you're a restaurateur or if you're in the travel industry or anywhere like that, then we know that you would have seen an issue over the last period. And more people now are taking second and third jobs. That they're having jobs that are not just basic salary. A high street lender likes X times basic salary as a pigeonhole for their affordability. You can't always see that if someone's earning bonus or overtime, or they're seasonal, or they've got a second income, or they're director of a company where they're taking it in dividends, or their accountant has advised them not to take it in dividends. There are a number of different ways where an underwriting department has a do not compute type of attitude to that type of income, whereas an underwriter can look laterally and interpret from a business point of view whether or not that person can afford the loan.
Yeah. So I guess so there's all this flexibility that's being brought to the table by specialists versus the high street. And that kind of flexibility can mean the difference between, getting on the property layer or not, or being able to remortgage and get onto a lower fixed rate or not. So there's definitely some value there. But I think sometimes home buyers or first-time buyers, they look at some of these products and they see the price. They see the price that they're paying with this. I guess, and that brings up a price and value. I guess there's also a consumer duty aspect to this. But Is that something you can also like expound upon a bit more? There is an elevated price associated with this, but it's kind of necessary in a way, really.
Well, and there are two reasons for price. One is cost of funding. So specialist lenders generally receive their funding in a different way to the high street. The high street tend to be retail investment backed, so they will have a retail arm where they're taking in current account savings, they're taking in other types of savings, and they're lending money out on the back of that. And that gives them an advantage where the cost of savings can be flexed against the cost of borrowing. So you tend to have a better rate for that. They also tend to be bigger, so the securitization rates tend to be better. So when they securitize loans, they get a better rate of return there, which means they can lend that money out at a lower rate, if you like, than the specialist lenders. The third reason, of course, is because they're taking lower risk. So if you look at the risk curve, you look at the types of loan that they're doing, they tend to be lower income multiple for the reasons we've just said. They tend to be lower LTV because that's the type of loan that they like, and they tend to be on standard construction, standard types of property. So therefore, the risk that they're taking on that loan is a lower risk than it would be for a specialist lender. And obviously the obverse is true. So a specialist lender tends to be lending to more non-standard properties. They tend to be taking more of a lateral view of income and affordability, still making sure it's affordable, but taking more of a lateral view, therefore ostensibly taking more risk than the high street lender would. And they don't tend to have a retail savings arm. Some do, but they tend to raise their money either through obviously through investor backing or through securitization. So their cost of funding tends to be higher. So you're always going to see, if it was a straight fist fight between the same criteria at a high street lender and the same criteria at a specialist lender, the customer should and would choose the high street every day because the rates are lower. But of course, most of the people that hit a specialist lender have already tried the high street and have found they can't get the loan.
Right. So, like, what would you say to a first-time buyer or a mortgagor that goes to, is working through a broker? They have a couple of different options in front of them, different specialist lenders, and they notice that higher price. Like, what would you say to them with regards? Because, like, you can talk to me around, say, the cost of funds, swap markets, and how that kind of, interplays into, the ultimate price that they see. But for them, I guess, what would you say to them?
So it's changed a lot over the last 5 or 6 years. I think previously most borrowers fit most lenders, so therefore it's price. It was all about what's the cheapest, what can I get? Let's decide whether I want variable or fixed. Now I want a fixed. What's the cheapest fixed I can get? It's different now because the first question now is, am I going to fit? Is that lender going to give me a loan? So what I would say to a prospective borrower, whether it's remortgager or a first-time buyer or a second-time buyer, is first of all ensure that you're secure. So can I buy that property? Can I remortgage? Am I okay with the lender? And most brokers will take that attitude as well. Let's secure your loan first of all. Now let's see whether or not that's going to cost you X pounds a month. Let's see whether I can get that cheaper. Now cheaper generally means the high street. So I'll try the high street first. You're not going to qualify for the high street because you've only had 1 year self-employment, or you're buying a property that's on the 10th floor of a tower block, or you've got fluctuating income from an employed point of view, or you've had a credit blip. You're going to need to go down the specialist route, and I'm going to try these lenders on a list of A to B to see which one's going to be cheapest for you.
Yeah. And I guess maybe another way to look at it from a home buying perspective is that a specialist is maybe perhaps like a stepping stone kind of mortgage. So it's like, let's say you're in the private rental sector and you want to be able to get on the ladder. Yes, you have to go with a specialist lender. Yes, it costs a bit much, but it's not necessarily about the cost that you're paying right now because these are 2, 3, 5 year fixed rates. It's not, an infinite amount of time. So you could be on, say, a 2-year fixed for, yes, a little higher cost, but then that kind of track record then helps you to be able to get on to lower costs over time, really.
No one goes to a broker and says, I want a mortgage. They say, I want to buy a property.
Yeah.
I need to remortgage. There's a reason I need to borrow more money. There's a reason why they go to that broker. No one wants a mortgage. What they want is the thing that they want. So if they want to buy a property and they can't get it on the high street and they get it with a specialist lender, then they've got the chance again. And most good brokers will revisit that client every year, 2 years, whatever the rate they've chosen, the product they've chosen, and say to them, I can now get you a cheaper cost of funding because you've spent 2 years with that specialist lender. I can now get you onto the high street. You could borrow more money or whatever it is. But the relationship between broker and customer or broker and client is not a one-hit situation. It's something where they revisit and potentially get their price down over time.
Right. I guess a good direction to go into now is kind of pivoting from like the main part of the specialist market, but into maybe more of a niche part of it, and it's really the first time buyer segment. Um, this is something where all the things that we've mentioned, all the hurdles that people are going to have to face, whether or not they're a first time buyer or a mortgage or whoever, going forward over the next year, they're going to have to contend with these things in order to get on the ladder. And there's it's not and for the first time buyers it's even worse. There is the cost of living crisis, but there's also the rental hikes that are going up, limiting the amount that they can save. Obviously you're an advisor for us, so I guess a little bit biased, I suppose. But I mean, what does the first time buyer market kind of look like for the next 12 months?
So the one thing we haven't mentioned in the talk about high street versus specialist is LTV.
Yeah.
And of course, LTV is a massive problem for a first-time buyer for all the reasons you mentioned there, whether they've saved a deposit, whether Bank of Mum and Dad can come up with a deposit, whether they've had a property for a while if they're not first-time buyers, but it hasn't gained as much equity as perhaps it could have done, particularly if it's outside London. Then they're going to be looking for deals that give them a higher LTV. And this is where I think the brokers are opening their eyes to the wider market, because previously it was, do you fit the high street? No. Well, you're going to fit a specialist lender. Specialist lenders don't tend to do higher LTV because they're already taking that higher risk with income. They're potentially taking higher risk with property. What they don't want to do is layer another higher risk on that with a 95% loan as well. The way they securitize, the way they're funded, often precludes them for going up that LTV curve. The high street will do that higher LTV, and mostly for first-time buyers, that may be the right route. Sometimes it may not be, because that may be a higher rate they could get down by using OnLadder and other types of lenders with a deposit builder who can give them that opportunity. New build is exactly the same, and of course there's been Help to Buy over the last few years, which is now no longer there, which has given them the advantage that they could borrow a higher LTV to buy new build properties. So brokers are now having to think, well, Help to Buy isn't there anymore. These guys need a higher LTV. They're not necessarily going to get themselves away on the high street, or even if they do, that rate's going to be quite high for a higher LTV product. What else is there? And this is where OnLadder, yes, I am biased, but an OnLadder type of product can help them bridge that gap.
Yeah, but I guess from like a broker perspective, I think everyone's starting to wake up to, Help to Buy is gone. That's year to date, June 2021. That was 60,000 people that were receiving Help to Buy loans. 82% of them were, first time buyers who obviously wouldn't have gotten on otherwise. But also, the remaining ones, the second steppers, they also need it as well. So I guess, from a broker perspective, so they realize that the value, but there are some barriers on their end. Because there are some intermediaries, there are some brokers that will just do first charge advisement. So what do you see are the potential solutions for that? Because I guess there's two routes really. It's upscaling so that brokers can do the first and second charge to make sure that they are control the process. And then I guess there's also potential for like JVs in order to be able to bring in, say, a second broker that specializes in second charge. But I guess, I don't know, how do you see that working though?
And it's not unusual. So the broker market have had this type of issue before with things like lifetime mortgages, where not every broker wants to advise on a lifetime mortgage. They need to find a triage type process where if they get a client that needs a lifetime mortgage, they can find someone that would advise on that. Some of the brokers take it all on. Some of the brokers have that triage within their own brokerage. So there might be 4 of them and one of them specialises in that type of mortgage. But typically, if they're in a network, then there'll be people within that network that do that type of loan. So I would not expect every broker out there to do everything that moves. They'll be looking for a solution that can provide that for them. So I think the way forward, and it's not just about OnLadder, and it's not just about that type of loan. Of course, that there's equity release for the older borrower. There's shared ownership as well in there. There's a whole market full of solutions, some of which are right for some clients and some of which aren't,
Right.
that need to be advised on. And I think for a broker to have that outlet to say, you need now to speak to my colleague or the person in my network that can give you that advice while still retaining that client is going to be key.
Yeah, and I mean this is a big part of the progression of the industry towards being able to provide these kind of products. There are a whole slew of them out there, but a big part of the reason why it hasn't necessarily taken off is because there needs to be more coordination with these intermediaries and with these mortgage lenders. We all have our different priorities. But if we want to address a first-time buyer's priority, we have to work together in order to make that happen. But this is where, from our perspective, like we've started to see the industry come together. There are some leaders out there like Craig Hall who are trying to get folks together in order to really talk out these issues. And I think that's a positive sign for everyone involved. First-time buyers especially, because they need solutions.
Well, they've just seen their massive solution pulled from under them. So Help to Buy's disappeared. And it was always going to, but people don't tend to react until it actually has. And builders must be, with their brokers, must be thinking about that at the moment and how they can provide the next solution for their clients.
Right.
You get a lot of brokers talking about holistic advice, and we give holistic advice to our clients. But if they're not advising on this type of product range, then they're really not, because they'll be seeing either clients walking away and not taking a loan, or they'll be seeing clients taking a loan that isn't appropriate for them because they're not understanding the width of the market that's out there.
Yeah, I guess another part of this. So there's the intermediary side, and getting either upscaling or JVs, or finding a way in which to be able to advise on two loans simultaneously. I guess on the other end of it is also, in order to provide the kind of scale necessary for our product or for other types of products, there's also the mortgage lender in all this, and there's specialist lenders out there that will have partnered with these types of products in the past, and there seems to be appetite on the building side of things as well. Given their mandate and the fact that they're a bit smaller and a bit more nimble. But what do you think it's really going to take for, say, a big six lender in order to be able to, to bring something like this on board? It's invariably, don't get me wrong, getting started with specialists, getting started with building societies, this is good. It's a great start. But in order to really put a dent into the problem, we're going to need a big six lender in order to, to really get things going. So what do they need to see, or what do they need to do in order to be able to get further into this market?
It's interesting because necessity is always the mother of invention, and they need to see it as necessary. And I think from a big six lender point of view, well, we do higher LTV, so that will cover most of you. And if you don't need the higher LTV, then we do lower LTV as well. It's almost like and we did a lot of Help to Buy. They almost need to see it as something where there's a market that they're missing out on completely from a commercial point of view, but they're also not satisfying the types of client that are coming their way. So they're potentially turning down more clients who are ending up in the specialist market and ending up taking different types of loan. I mean, we've said before as well that I think this sector suffers for the lack of a label that sits over the sector. So whether that label is deposit builder mortgages, whether it's a type of lending, because everyone knows what equity release is, everyone knows what high street lending is, everyone knows what buy to let is. People don't tend to see this as a sector. They see it as a set of individual lenders that are maybe doing their different thing. I think if they see it as a sector, they'll see it as a sector they need. And I think that's where the next step comes. If they see more lenders out there, if they see more specialist lenders doing business on a second charge basis with these type of lenders like OnLadder, then I think they'll see it as a potential source for themselves as well. Equity release started small, buy to let started small, bridging started small. You're now seeing high street lenders doing more of that, either themselves or via their subsidiaries, because they know it's a market they need.
Yeah. I guess with regards to visibility for these mortgage lenders, being able to visualize the problem and potentially the benefits, not just for the buyer but for them. I guess this also comes down to how close they are to these borrowers, these types of borrowers. Don't get me wrong. I mean, there's definitely from a risk compliance standpoint, it's obviously better for them to have a lower LTV. It just is, and there's plenty of regulations that kind of box them into this. I guess for on a more human level. For us, we see it all the time because, hey, we did a very extensive customer discovery process. We talked to 4 dozen, first-time buyers and had 30 minutes to an hour each with all of them talk about these problems, what they're experiencing. But I also just every time I go out with, say, friends or to a networking event, I feel like I've never left my job. Because I end up telling them what I do, and they go like, "Oh God," and they give me their story around either how they've tried to and failed, or maybe they did it but they got by the skin of their teeth, or if their parents helped. And perhaps it might be asking too much for them to necessarily do as extensive a work as us, but maybe just closing the gap between them and brokers, and because they see this and they definitely see I can't speak for the other products in the market, but the intermediaries that we've talked to, the brokers that we've talked to, they see our product and they see the value in it. It's about, I guess, breaking down that barrier to what they see versus what intermediaries see, what the opportunities they see.
And I think a lot of it is around that label. It's seeing it as a market. So they can see it as a set of problems. They can see people that are not being able to get on the housing ladder. They can see people that can't get their mortgages in the high street and they're going via specialist lenders. Do they see that as a whole? Do they see that as an issue in the market that needs solving? I'm still not sure, and we've discussed that before as part of our general discussions. I think if they saw people needing higher LTV products as a market rather than as individuals that end up going one way or another, then they would see the solutions as part of that market as well. And I think there's work there to do for us.
Yeah.
There's work there to do for
100%.
the other lenders too, to see it as something that the regulator can get hold of, that the industry press can get hold of, and by doing that, you lobby hard enough that the high street lenders get hold of it too.
Yeah.
And I think it will happen. What we need to do is try and accelerate that happening, because Help to Buy bailed them out. Help to Buy definitely bailed out a lot of this issue over the last 3, 4, 5 years. A lot of the governmental schemes that came out via new build as well help that issue too. The government obviously put pressure on the high street lenders particularly to carry on offering higher LTV products, when, as you rightly say, I'm sure they'd rather have a lower LTV back book. This is another way they can do that.
Right.
And that needs to be obvious to them.
Yeah. And what it comes down to is we just need to get started, get to market, but also for this slice of the market, there are other options out there. We all are going to start with a specialist. We're going to start with building societies, and then that way we will be able to show them what could be possible, and then be able to give them a picture of, if they were to come in, then what is the effect that we could have on this issue.
Oh, a 95% loan through a high street lender is absolutely right for a lot of people. It isn't right for everyone. It isn't even right for the people that have got a higher deposit to take a lower LTV loan, because there are instances where they're taking a lower LTV loan at a higher rate than they could have had if they'd taken a top up on their deposit too. So it's about options. It's about the high street recognising that this is an option that they need to be able to offer as part of their portfolio.
Right. And ultimately, the broker is going to decide what's right for them. Like you said, different products for different customers.
Definitely.
All right, I think that's it. Richard, thank you very much for coming by.
Thank you.
This was great.